Thank you, Zoe. Ina rangatira tēnā koutou ngā mihi matakui. My apologies if I've made a mistake there, but I am trying. So good morning, everybody. Welcome to our long-term plan workshop. One of a number, obviously, a series. And without any further ado, I'm going to invite Bill to open us with a karakia, and then I'll pass over straight away to Melissa on account of the fact we have Brad Olsen speaking with us. So Bill, could you open us, please?
Totu te kupu, totu te mana, totu te whenua, totu te reiki, tihei Māori ora. Just wanted to kia kaha, kia mana o nui, e ho, kia ora.
Kia ora, Bill. Thank you for that. So as I said, I'll just pass directly over to Melissa to open this. I understand we have Brad Olsen online. He's with us till 9:45, I believe. So let's use his time wisely. So the floor is yours, Melissa.
Perfect. Thank you, Mayor Susan. So good morning, Council and Community Board chairs. So we do have Brad Olsen online to present to you this morning, just providing an economic update. This was a request that came out of, I think, the workshop on the 10th of September. The previous update from Brad in August, well, I think June, sorry. Things have kind of shifted a little bit in the economy, so we just wanted to bring Brad in, provide that update before we crack into the financial strategy discussions following this. So I'll hand over to you, Brad.
Awesome. Kia ora and good morning, everyone. Just checking that you can hear me.
Can indeed. Nice to see you, Brad.
Fantastic. All right, let me share a screen as well, and then I have, of course, done some homework. So I'll sort of go through for the next 25-ish minutes on a few trends that we're seeing and thinking. I've got some of the local stuff in here, don't get me wrong, but I think as well, given the topic of the conversation and the outlook for the long-term plan, of course, over a 9 to 10 year period, I've got a bit more of our sort of forecast thinking. Infometrics we're currently in the sort of end stages of updating our forecast. It'll go live on Friday, and so I'll sort of talk through sort of how those implications have shaken out. Long story short, not a lot has changed in our broad outlook, but I think certainly how people are viewing the economy has. You'll see that in the title of the conversation as well, in terms of greener shoots in 2025, and that's very much true. We do see better economic activity starting to come through next year. The difficulty, I think, is that I do worry sometimes that people have gone from being in what seems like quite a shell shock state with high interest rates the last 6 months or so, to thinking that next year is just, like I said there, rocket ship to the moon, sort of quite excited levels of economic activity. That's not quite true either. There's sort of a bit more of a middle ground, a bit more sort of something relative in the middle. First things first is how much the interest rate outlook has changed. And of course, that has huge implications for both short and long-term economic trends nationally and locally. To highlight just how big those have been, the blue line here looks at the Reserve Bank's forecast for the official cash rate when they published their May monetary policy statement, come through to August. And that was the first time that they'd cut the official cash rate down 25 basis points and forecast the green line there, and then we've seen subsequent to that, you'll see the little orange bit just below the green line with the 50 basis point cut the other day, more than was sort of anticipated by the Reserve Bank itself in August, and you'll see market pricing there at the start of October, giving you an idea of where markets are thinking. Realistically, I think probably where we're thinking things go ourselves is a bit more in the middle between the blue line and the green line. Long story short, interest rates are coming down. Lower interest rates means that people's mortgage repayments won't be as high. The sort of burden for commercial entities to get their lending ideas over the line won't be as high either. And so into next year, as those interest rates come down, there's more ability to spend, and that will stimulate more economic activity. The reason I sort of start with this chart is, one, because interest rates are so important. Two, because if anything should highlight the uncertainty in the economy at the moment, it's this. We've had fairly usual or expected levels of economic outcomes. We expected weaker economic activity, we've got it. We've expected spending to be down, we've got it. We've expected construction to be lower, we've got it. But you can see in the space of 6 months or so that we've whipsawed between thinking interest rates could remain high and in fact maybe go higher, through to now expecting some pretty savage cuts. So that uncertainty in a sense remains quite a bit. So far, we've continued to see that weakness come through in the economy. You see like a little bit of a perhaps blip or a bit of a shift in trend on the spending numbers, a bit of a lift in the last month or two. Not huge, but we do sort of think that part of that is that households have hit the top of their high interest rates at the same time as you've seen just a little bit of relief from tax cuts and similar come through. You'll see it hasn't sent spending soaring, but it just has sort of shifted the dial a little bit more. The trends we've got for Waipa specifically up until June suggest a very similar track to this, slightly better. In fact, we're just waiting and hopefully in the next couple of weeks we'll get a new spending update. But again, we're not expecting it to jump up, but we're not necessarily expecting it to contract massively either. I think the big thing here to bear in mind in terms of that sort of economic outlook is that although interest rates have started to be cut, and you've seen some sizable cuts so far, of course, that's only good if you had your mortgage coming up sort of right then and there to refix. Otherwise, there's still a lot of people that have got sort of 6, 9, 12 months to come through. We'll get to some of those figures, but just bearing in mind that really, I guess, our view, particularly looking at their spending figures and how that comes through the economy, is that the next sort of 6 to 9 months is a period of still tougher economic activity where people are worried about their jobs. And then in 6 to 9 months' time is when those interest rate cuts start to kick in a bit more. We've also seen sort of stable signs coming through in the primary sector, upbeat in a sense. You've seen particularly dairy that's been in a better position. I saw the global dairy trade auction overnight, I think down 0.3%, but realistically, a few bobbles around here and there. The direction of travel is a lot stronger. You've seen the Fonterra payout continue to increase as well, and a healthy start to milk volumes across the country. All of that is encouraging. I guess the trend that we always keep in mind, though, is that those on-farm costs have still been quite elevated. The last 9 months, they've effectively been flat and they've stabilised at a new high level, but they're still 25% or so higher than a couple of years back. And so you'll see on this inflation-adjusted commodity price chart that the sort of returns are broadly sort of fairly similar to what they might have been back in 2019. Higher revenues, but also higher costs means that profit's sort of a bit more stable. That's not a bad thing because we're starting to see a little bit more activity in the primary sector that we expect will support the economy, but might not boost it up quite as high. We are still in a bit of a holding pattern as we go through the various ups and downs. We had COVID, we had low interest rates, we had high inflation, we've then had high interest rates to combat that. And so we're still trying to figure out where the new equilibrium, the new Goldilocks zone effectively is. In terms of job activity, again, I sort of show this to put things in context, and I'll show you the Waipa figures in a moment. Jobs activity has been a lot more sort of diverse across the country. It's slowed in general from what was much headier levels going back sort of 6, 12 months, but you'll see quite a difference coming through across the country. The stronger levels of activity through the sort of Mid-South Island, that is more driven by stronger tourism activity, not necessarily recovered fully to 100%, but the likes of Canterbury, Otago, and even the West Coast to a degree, seeing more international tourism now than they had 12 months ago. And so again, a bit more of a build-up of momentum. You can see a number of other areas, particularly the lower North Island, seeing contracting or effectively zero growth in jobs. Part of that coming through the likes of the government's cutbacks in the Wellington region, but also you're seeing that higher energy prices in recent times, combined with low profitability and struggling revenue, has curtailed quite a bit of manufacturing. There's a lot of high-profile cases, particularly in Ruapehu district, but that does seem a more general trend that we're seeing a number of contractions in the lower north. Upper north, including the Waikato more generally, a little bit more strength. It's still softer than before, but hasn't been hit quite as hard. And I guess it comes back to that point where we see a lot of economic indicators starting to show, in a sense, some sort of or some form of plateauing. You can see that as well in terms of job numbers coming through locally. For the June 2024 quarter, the latest official set we've got, jobs growth up 0.4% in Waipa. Not the worst, it's sort of about middle of the pack of all areas, and it's still growing, which is encouraging. But again, you look at that sort of over a longer period of time, and what was a fairly strong continued upwards gain has just moderated out a bit over the last sort of 12 to 18 months. Again, businesses not seeing the greatest levels of sales, not wanting or able to hire quite as many additional people, and that's sort of keeping activity a bit more restrained. Let's talk then about the housing market, because of course that will have implications for council's finances and a lot of the activity that council is doing and related to. At the moment, a lot of properties still on the market, both across the country and across the wider region. In fact, nationally, we're seeing about 26 weeks worth, so half a year's worth of sales of properties available on the market that could go for sale. So, you know, if there were no more houses that were put on the market today, it could still take half a year to clear everything that's away. So still a feeling there's a lot of competition, and that high level of competition to sell your house at the moment is still producing effectively flat or subdued house price expectations. As I said, high numbers of properties that are available for sale in terms of actual sales volumes, not awesome, sort of, ticking back up a touch, but not sort of improving all that much. And realistically, what that's highlighting is that it's taking a lot longer to sell a house. There's not as many sales because although more people are trying to sell, the number of buyers are still restrained in a sense by the higher interest rates. Yes, they've started to come back. Yes, that will stimulate a few more people that can get a mortgage, but interest rates are still high on a relative basis, and so that will take a bit of time to flow through. All of that means when we look at house prices locally and across the country, Waipa's house prices are effectively flat on a year ago. They're still down about 5.3% as well from their peak. And that is very much those competitive pressures that have come through that means that more and more the limited number of buyers are able to go out and say, well, look, there's 5 house sellers here in the next street or so. Whoever gives me the lowest price is going to get my money. And so those sellers then are going, well, if I need to sell my house because it's not currently working for me, then actually I'm sort of happy to maybe take a little bit of a discount. Excuse me. The other trend, or I guess the other trend shift that we're seeing at the moment in the housing market, or related to the housing market, is the shift in migration. And you'll see that here with our forecast for arrivals and departures. Effectively with, again, not as many or not as much spending in the economy, not as much demand for additional workers, the rising unemployment rate, there's also a decline in the number of arrivals coming into the country. At the same time, we've seen that those fewer job opportunities here locally means that more Kiwis, particularly young Kiwis, are looking for opportunities overseas and leaving, which is partly driving that increase in departures. What we're also seeing, though, is the number of more recent-ish arrivals who haven't been able to find a job by the looks and sounds of it, and they're also departing. Now, that's important because it is slowing back population growth quite a bit, and with population growth slowing back, with still sort of high relative interest rates, it doesn't create as much of a scene for further and further development because there's not as much relative demand for housing. What I will say is that when we publish our forecast on Friday, we will be expecting a net decline in migration, so a net negative, more outflows than inflows around sort of early 2026. We see those numbers of arrivals continuing to come down, probably a bit sharper than are on the chart at the moment, but the number of departures remaining high as well. All of that has seen the number of consents, this is residential dwelling consents in Waipa, come down to about down 47% or so from a year ago. Of course, you can see there that the numbers have come off quite a high builder, and so there's a sort of a bit of an averaging effect there where there were a lot of consents that have come through, not as many in the forward pipeline. For the likes of non-residential activity, again, a steep pullback, for Waipa, down 57% in terms of non-residential values. Again, the combination here for both residential and non-residential of those higher interest rates, of people not, particularly in the non-residential space, not seeing the need to expand their business operations as much, or even if they do, just not finding it as easy to finance. Related to that, of course, we've seen quite a fall. These are national figures, but sort of bears the point out around lower investment coming through from central government. You can see the education consents, for example, at their lowest in 14 years. That's important because although the government has signalled substantial levels of infrastructure investment, that continues to be a challenge to actually get it out the door, get it planned in the first place, and then get it out the door. You'll see various forecasts here of government investment depending on when the Treasury made their forecasts. Biggest or most important one to recognise here is the orange and dark blue line at the top. The orange line coming through in budget, the dark blue line coming through in the pre-election update September last year, and you'll see that there's been nearly $5 billion less infrastructure investment forecast in the budget compared to pre-election. So that does just highlight the government is struggling to immediately get its investment programs going. That always happens after a change in government. To be fair, that seems to be a constant profile from government. Here is every forecast that I could pull since 2015 of government forecasts of infrastructure investment. And effectively, every time there's a new forecast, you lift the number up and you push it out a year. So that, again, challenge of delivery means that things might be a bit slower on the pickup on investment side than might have otherwise been anticipated. Last sort of couple of bits, one is around the rental demand, and of course that has implications then for housing activity. We've seen that rental inflation has started to slow back a bit as we've seen that sort of slowdown in population growth, as people have sort of capped out how much of their incomes they can pay. And that's sort of coming through a lot clearer in new rentals. There's a few more options out there for people to choose, not as many people that are trying to choose rentals, therefore that rental inflation starting to come down as supply and demand shifts. For the likes of Waipa, you're seeing that again as well coming through on these figures. Not a definitive drop, it's not like rents are becoming cheaper, but of course a little bit more of a slowdown and a stabilisation in that rental pace. That's important because it means that, again, the return that people might be looking for or able to get in the rental market is more limited. It's critical because, as you can see here, the difference between sort of your rental return, if I'm, an investor or something trying to rent out a property, and the real bond rate is pretty small. So why would I do a whole lot of work as a landlord when I could just put my money into government bonds, which are one of the safest forms of assets out there, unless you think the government's going to default. So I could do nothing and get the orange line, or I could do a lot of work and get the blue line. At the moment, it's not quite as worthwhile to do the whole renting thing at the moment. And the only reason you would go and rent out property is if you expected larger house price gains. At the moment, we think that's fairly limited as well. In fact, we think it takes until 2029 for house prices nationally to get back to their sort of pre-pandemic peak. We are the lowest in the market, but at the moment, the combination of that slowing population growth, all of the building that New Zealand, and including locally in Waipa, has done the last couple of years means there's more supply coming online now at the same time as the population is slowing back. And although lower interest rates would normally stimulate a bit more spending, what we're also thinking is that as that happens, the Reserve Bank's new debt to income limits will sort of cap out just how much can start to come through. We know as well that commercially, given those spending figures aren't quite as good, there's not as much of a return on commercial rents either. So a difficult position for both residential and commercial activities. Last, and I think most important bit is that outlook piece. Long story short, and there is a bit of context around this chart. These are some figures I've pulled together from Infometrics' sort of expectations and forecasts for residential consents for Waipa in the orange, non-residential consent values for Waipa in the dark blue, and section numbers for the combined Bay of Plenty and Waikato sort of land districts, and that's just because of data availability. Long story short, you'll see there that we don't have a big lift coming through in any of those metrics really over the longer term. And really that's driven by the combination of factors that I've just outlined. House prices at the moment are lower than where they were previously. Building costs are higher. Your rental returns aren't fantastic. Your expectations of capital gains aren't fantastic. Long story short, there's not nearly as much sort of reason that people would want to develop as much housing at the minute. And we don't expect necessarily that interest rates coming down will immediately stimulate a burst of investment. Now, to be fair, a lot of uncertainty around these numbers because, and we could sort of, I guess we've probably got a view that there's upside risk to these. Our figures are informed by not only our general forecast expectations, sort of looking at long-term trends between a whole lot of things, but also sort of signaled intentions from developers and what have you. Now, often they don't go particularly long-term, but often we also do have a bit of a view over what activity is coming to market. What's clear at the moment in our own conversations with developers and others in the housing space is that people are starting to turn their minds more to a bit more activity, but no one's been willing to sort of confirm their investment intentions in the short or the long term yet. And so that's sort of trying to figure out the timeframes around when there might be enough interest rate relief to stimulate higher house prices and more buying. It would take all of that to come through to then sort of stimulate a greater level of construction activity as well. So long story short, subdued and sort of a bit more stable for the next wee while at lower levels after a bit of a build-up.
Brad, can I just interrupt you for a minute there?
Please.
For some reason, our speaker here has made you sound like you're in some Tetris sort of game. So I'm just trying to see if staff are able to clarify the issue with the sound. We heard you perfectly up until the sort of last paragraph or so.
Oh, bother. Let me turn off the mic and turn it back on.
Okay. Can I invite you, Brad, does he need to dial out and come back in again? Can I ask you to dial out and then try and come back in again, and we'll just have to restart the whole thing. Same for you, Roger. Look, my apologies for that. There's a bit of a bug in the system. I think it appeared yesterday too. So hold that